Welcome to the virtual roadshow series presented by Channelchek and Noble Capital Markets. Of the 6,000 small and micro-cap companies listed on Channelchek, today we're featuring FAT Brands, NASDAQ ticker symbol FAT. Research coverage of FAT Brands is provided by Noble Capital Markets. Noble is a FINRA-licensed, SEC-registered broker-dealer. All Noble research is available on Channelchek. Following the formal presentation, Joe Gomes, Noble's senior research analyst covering FAT Brands, will ask our presenter a selection of the questions received during the broadcast. And now, here is Andy Wiederhorn, President and CEO of FAT Brands, to make the presentation. Andy, take it away.
Thank you, and hello everyone. Welcome to the FAT Brands investor presentation. This presentation, dated December 14th, 2020, yesterday, is available on our website under the investor section, as well as through the Noble Channelchek different features. An 8K was filed also to show this presentation, which is available for download. So FAT Brands is a global restaurant franchising company with 9 different restaurant brands. We have 305 different franchisees across 37 countries. 101 of them are multi-unit operators that own more than one restaurant. 36 different US states, and we have more than 700 restaurants either open or under construction that will be open very soon. Our 9 different restaurant brands are Hurricane Grill and Wings, Fat Burger, Buffalo's Cafe and Buffalo's Express, Ponderosa and Bonanza Steakhouses, Yala Mediterranean, Elevation Burger, and most recently our acquisition of Johnny Rockets. The Johnny Rockets acquisition, which was completed in September of 2020, in the middle of the pandemic, we acquired the brand from Sun Capital Partners affiliate for the purchase price of $25 million. This was a transformative acquisition for FAT Brands because it nearly doubles the size of the company in terms of number of restaurants, will roughly double our post-COVID EBITDA numbers, and raises our revenues by approximately 50%. The synergies that we're able to realize by integrating the Johnny Rockets brand into our platform are significant. When we make an acquisition, we might pay 5 or 6 times cash flow for that acquisition, but immediately in the first 30 days, we're eliminating the corporate headquarters, most of the executive suite, the accounting department, the legal department, purchasing, things that we already have at FAT Brands. So essentially, we're paying 2 or 3 times cash flow. So it's very, very profitable and accretive for us to make these acquisitions and board them onto our platform where we have all of these services already in place. If you look at the pre-Johnny Rockets and post-Johnny Rockets numbers, we had $14.9 million in royalties in 2019, which included only 6 months of Elevation Burger. And with Johnny Rockets, that's a $13.6 million increase in royalties for their 2019 numbers pre-COVID, bringing it to $28.5 million. So doubling our royalty revenue on that basis. If you look at the number of units and the system-wide sales, our sales go from 394 million without Johnny Rockets to more than 700 million in sales. Our number of locations to more than 700, including those that are under construction, and our number of franchisees to more than 300. This just doubles the size of our platform, increases our purchasing power, allows us to pass through more benefits to the franchisees, gives us more marketing muscle, and really brings the FAT Brands platform to the scale of a public company that we needed to be at. So now those public company costs are spread across the 9 different brands and the earnings power of the platform. Just recently, last week, we announced the merger with our holding company, Fog Cutter Capital Group. Essentially, Fog Cutter is getting tucked underneath FAT Brands, which enables, finally, the structure to be quite clean and efficient moving forward. This will allow FAT Brands to take advantage of Fog Cutter's $100 million net operating loss carry forward to shelter future income. And historically, this is something that we've tried to get done for the last couple of years. It's taken quite a while because it's very complex. But by getting this done, Fog Cutter no longer needs to be an 80% shareholder. So historically, in order to have a parent-subsidiary relationship and use Fog Cutter's net operating loss carry forward to protect and shelter the FAT Brands income, Fog Cutter would have to own 80% to file a consolidated tax return. But by having to own 80%, that limited how much public float could be available, how much new stock could be issued to raise capital and how much common stock and how much new stock could be used for acquisitions. By completing this merger, this brings the 80% issue to a close. Now, by tucking Fog Cutter under Fat Brands, the 80% issue goes away. Fog Cutter can raise capital in the markets. It can issue common stock in terms of an acquisition. It has tremendous flexibility, and in COVID-19 era, that's critically important. Under the terms of the deal, there won't be any change to the Fat Brands listing. And Fat Brands public shareholders, not the Fog Cutter shareholders, will receive a special dividend with a record date of December 21, next Monday. And they will receive preferred stock, basically 0.23 shares of that $25 preferred stock, Fat Series B preferred. The symbol is FAT, Series B and P for preferred. So FATBP. And that's equivalent to $5.80 of liquidation value or face value of the preferred. And at today's trading price, around $4. So it's really a big benefit to the public shareholders of FAT. And again, that record date is December 21. The Fog Cutter shareholders will just receive their pro rata share of the Fat Brands shares that Fog Cutter already owns. They're just getting passed through to the Fog Cutter shareholders. And then this merger will be complete and we can move on as really a traditional public company. On a fully diluted basis, including approximately 2 million warrants that are outstanding at Fat Brands at an average strike price of a little bit more than $5. The public float on a fully diluted basis is about 46%, which is a great next step from us, whereas before it was only 18.5%. The intercompany debt between the two companies is eliminated, and there's slightly more debt that comes onto Fat Brands' balance sheet. But there's plenty of revenue and cash flow to support that. If you look at our 2019 highlights before Johnny Rockets, you can see that from 2018 to 2019, we increased our royalty income by 23% to $14.9 million. We increased our total revenue, which includes advertising fees and things like that, from $17.8 million to $22.5 million. With the addition of Johnny Rockets, it should be close to $36 million on a pre-COVID or post-COVID basis. If you look at our adjusted EBITDA, it increased by 54% from $5 million to $7.7 million in 2019. And that's with only 6 months of the ownership of Elevation Burger. If it was annualized, it'd be closer to $9 million. And so our margin increased from 33.9% to 41.7%, a significant increase. And with the addition of Johnny Rockets, it will be over 50%. So we think that our pre-COVID or post-COVID comparable numbers with the addition of Johnny Rockets will be more than double our 2019 adjusted EBITDA numbers. So more than $15 million, probably a little bit higher than that on a post-COVID basis. When that happens is anyone's guess, as you all know, but assume that Q3, by the time we're into Q3, people should be vaccinated, consumers should be out and about again, and we think that sales will recover quickly. Many of our brands, because they're casual dining and located in the Southeast, or because they're fast casual and have extensive delivery and to-go options, are performing at more than 100% today. If you look at our balance sheet and our financing, this was another pivotal event during 2020. We raised, through our securitization facility, a $40 million initial round of bonds in March of 2020 and another $40 million, bringing it to $80 million in September of 2020 to complete the Johnny Rockets acquisition. We also raised $9 million of new capital in Series B preferred, the same Series B preferred that's being issued as a special dividend. The conversion of some old Series A and Series A1 preferred to Series B made that total number about $15 million. So that $15 million of Series B preferred, along with another roughly $15 million that's issued in special dividend, brings the Series B preferred float to $30 million, trading on the NASDAQ, again, under the symbol FAT, B, and P for preferred. The Series A preferred that remains outstanding is about $8 million, and we've agreed to redeem that Series A preferred during 2021, which will have a significant savings in terms of cost of capital to the company. You can see the different rates that we're paying for the securitization facility, the seller note, and the different Series B preferred and Series A preferred here on this slide. We intend to refinance our securitization facility in Q2 of this year, And that will further lower our cost of capital. Being now a third-time issuer going into 2021, we expect that our bonds will be rated investment grade on some of them, the senior tranches, and that we'll get a much lower cost. And that will just pass right through to our cash flow and available funds for further acquisitions and things like that.
Thank you, Andy. Great presentation. I am Joe Gomes, the Noble Capital Senior Analyst who covers FAT brands. Here are the questions I've selected from the audience, as well as a few of my own. So congratulations on the fog cutter announcement. Maybe you could talk a little bit about, briefly, is what will the new FAT brands ownership look like following the fog cutter merger?
Yeah, sure. So historically, fog cutter owned 81.5% of FAT brands, and my family and I owned approximately 80% of that. So, there's very little public float available at the FAT brands level and very little public float available at the fog cutter level. Fog cutter went private over the summer and ceased trading, and in preparation for this merger, hoping that it would occur. And so today, on a look-through basis, before the warrants, our family ownership is probably in the mid 60% range, and on a fully diluted basis in the mid 50% range, hence 46% fully diluted public float. So I think it's going to really help the stock in terms of trading and liquidity. Of course, doubling the size of preferred shares out there to a healthy $30 million really makes that a marketable security separately listed on the NASDAQ.
Okay, great. And with the acquisition, are there going to be any adjustments made to the outstanding warrants? Or are they just going to flow as they are?
Yeah, the warrants are not tied to the acquisition, so they become exercisable post-merger. So there's no special dividend to the warrant holders, and those warrants that are $5 warrants are cash warrants, and they're exercisable upon the completion of the merger, which is expected to close around the 23rd or 24th of this year. Now that the 24th is a federal holiday, we have to figure out if it's the 23rd or what day it is, but our year end is the 27th, so either way, the merger will close before that. The preferred shares will be issued to the FAT common shareholders, and away we go.
Great. And let's talk a little bit about Johnny Rockets. You mentioned it, fantastic acquisition. How's the integration going? Can you talk a little bit about the synergies? How many of the locations of Johnny Rockets are kind of still, shut down or are operating at a very reduced capacity because of COVID?
Yeah, sure. So the integration's gone very, very smoothly. It's been 90 days now, and we've retained the staff that we're going to keep. We kept about a dozen people out of about 25. We have integrated all those departments. We have very active franchise development across all of our brands right now, including Johnny Rockets. So excluding Johnny Rockets, FAT Brands has opened around 34 or 35 restaurants, new restaurants this year during COVID-19. And Johnny Rockets, another 30 new restaurants this year during COVID-19. So very active development. And that I think will continue into 2021 as we have a healthy pipeline of new stores being developed. Now, Johnny Rockets is definitely a theme brand, much more so where I would say Fat Burger, for example, is an urban brand, and Elevation Burger more of a suburban brand or soccer mom brand with healthy organic beef. And then Ponderosa and Bonanza Steakhouses are family dining, mainly in the Midwest, the Northeast and Southeast. Hurricane Grill and Wings, Buffalo's Cafe in the South and Southeast, and then Elevation Burger up and down the East Coast. And so when you think about the theme brand of Johnny Rockets, you have amusement parks, cruise ships, movie theaters, shopping centers, definitely areas that are more affected than some of the urban areas or residential areas that have some normalcy to their business. Now, we all know big city, downtown, urban markets are hit hard, but we really don't have a lot of restaurants in those markets. So on the theme park venue, Johnny Rockets is probably running at about 60% right now of normal, where Fat Burger, maybe 85% of normal with delivery and to-go, Elevation Burger in the 80s, Hurricane Grill and Wings, Buffalo's Cafe, over 100% of normal because of the increase in delivery and to-go, and then outdoor dining. So it's kind of a mixed bag there throughout. And then the steakhouses like Ponderosa and Bonanza, much lower volume because of all the dining room closures, well below 50%.
And for kind of a follow-up on that, do you have any I know it's difficult to assess this, but time frame with the vaccine being rolled out here as to when you might be able to reopen some of the temporary closed restaurants, or is that just too difficult to answer at this point?
Well, so I think we're going to see this in phases and in different levels. So today you have delivery and to go available everywhere. The problem is that like a brand like Ponderosa and Bonanza doesn't really do a lot of delivery to go. They do a little bit of it, but not a lot of it, right? Hurricane Grill and Wings is doing plenty. Buffalo's Cafe is doing plenty, but that's like from 10% to 30%, not 85% like Fat Burger, Elevation Burger, or Johnny Rockets for those stores that are open. So I think we'll see dining rooms at some level reopen after this last wave of COVID gets behind us. Is that sometime in January or sometime in February? Who knows? It's governor by governor, as we all know right now, and county by county to some extent. But sometime in the next couple of months, I think that we'll see dining rooms start to open up again. And then as the weather improves and we get through the winter, of course, we'll see more outdoor dining again. And then as the vaccine develops, we'll see that consumers be able to go out more and there'll just be less restrictions. So we're really trying to step back and saying, like, look, nobody knows exactly when COVID's going to come off like a Band-Aid, but it's probably safe to assume that by the time we get to Q3, we ought to be at a point where consumer demand is so pent up and people have been vaccinated that things will bounce as close to normal as possible, maybe 85% for Q3 and Q4, but so what? That's plenty, and that's good enough to get going here. And on a post-COVID basis, our numbers are so significant because of this acquisition. We're just, we can't wait for it. And we're trying to do everything we can now to help our franchisees just cope with this for the next few months.
Okay. And you touched on it, but maybe you could give a little bit deeper, more color, on some of the programs that you're working on to increase sales, such as ghost kitchens and the third-party delivery services and co-locations. Maybe you could touch a little bit on that.
You bet. So we started co-branding in 2012, and today we have more than 100 restaurants that are co-branded. And co-branding, that's usually like with our Fat Burger brand and our Buffalo's Express brand, similar to a KFC, Pizza Hut, or Taco Bell, where you have two signs out front, two menu boards inside, one kitchen, one cash register, but the customer can choose from either menu and has much more menu diversity. Very, very successful. What sprung out of that, of course, was third-party delivery and virtual restaurants and ghost kitchens. Third-party delivery we started about 4 years ago. We were one of the pioneers with Uber Eats and Postmates to test it in California. In the old days, the Uber Eats drivers would come to our restaurants, pick up 100 burgers in each Suburban, drive to a different corner of the city and wait for someone to call and order a pre-made meal, which was cold and soggy by the time they got it. And that sort of led to the development of customized ordering on the Uber Eats app or the Postmates app. And we all know today with the various apps like DoorDash or Grubhub, our brands are on all of those apps today. That's a low-hanging fruit for Johnny Rockets, which was not on every brand. And we're now implementing that for all the delivery apps, all the delivery brands. But the difference here is on delivery, the restaurant operators paying a percentage to the delivery company, and then their customers being charged a delivery fee as well. So the benefit, though, of using the delivery apps to grow your business is that they're marketing to their 3 million users your brand. So if it's only the Johnny Rockets or the Fat Burger app that you're looking at, you're only showing it to Fat Burger customers who came to visit that site. But when you go to Uber Eats or Postmates or DoorDash or whatever, you're seeing their 3 million customers in your city or in your surrounding area, and they're all seeing your brand. So it is advertising. Make no mistake about it. There's advertising that goes on there to promote those brands. Then there is like Olo, which is your own online ordering platform, and we're implementing Olo across all of our brands today. Again, Johnny Rockets, as an example, didn't have Olo, didn't have its own online ordering platform. So that a customer that's a repeat customer can go directly to the brand, pick what they want, and still we outsource that last mile delivery to a delivery company. It could be an Uber Eats driver, a Postmates driver, it could be a DoorDash driver, and there's a program called Hunger, which links up with Olo, the online ordering app, and hires that driver to make that last mile delivery. But essentially the restaurant operator saves that 20% that he might pay Postmates or Uber Eats for the marketing of getting that lead in the door. So it's very positive for operators to get their repeat business using their own online app. But if they're advertising for new customers, then they're using the third-party app to get that business. So that's how the third-party delivery business has changed a bit. Then we talk about ghost kitchens. We've been an advocate of ghost kitchens. We have between 1 and 2 dozen ghost kitchens open now or under construction. We started them a couple of years ago overseas, like in Singapore. We have a couple of them there that are very busy. We have a number that we opened in Chicago, Philadelphia, in Texas, in Southern California, in Northern California. And a ghost kitchen is an industrial warehouse site. There's no brick and mortar restaurant for a customer to visit. But it makes the brands available on the delivery platforms where a restaurant operator goes in and rents a space in a delivery site. They're preparing 1 or more brands of different food. It's available to order on the delivery app, and the customer cannot go pick it up there. It's just for delivery only. That's a ghost kitchen. One more step from there is virtual restaurants. And this is really a competitive advantage that Fat Brands has because we own 9 different brands, just like co-branding. Virtual restaurants is where we're allowing our restaurant operators to take some of our additional brands that they don't have as a brick and mortar brand at their restaurant and make it available for delivery only, essentially creating their own ghost kitchen in the back of their restaurant with our other brands. So you could be a Fat Burger operator co-branded with Buffalo's Express having chicken wings. But you could be selling for delivery only, a Johnny Rockets burger or Hurricane Grill and Wings. And yeah, you have to bring in the packaging and the different ingredients, but all that stuff sits in the refrigerator, the freezer, or on the shelf. It's pretty easy to do, and it gives you incremental sales. And from the customer standpoint, we can get to market faster with another brand because it's available immediately on the delivery app or on the online ordering app. And it's really a benefit. If we can get an extra couple $1,000s a week to an operator, that'll move the needle significantly for them.
Interesting. I wanted to go back for a second. You touched on it briefly, with the Johnny Rockets acquisition, how it increases the number of franchisees, and you kind of also talked about the number of new locations that are being opened. So are you seeing interest, let's say, from the Johnny Rockets franchisees for the existing Fat Brands concepts? And similarly, from the Fat Brands franchisees, interest in the Johnny Rockets concept?
Yeah, so 2 entirely different messages here. One is that franchise sales in general in 2020 have taken off like I haven't seen in a long time, meaning that a lot of people are saying, hey, well, I want to own my own business. I want to move forward. I don't want to live in the city anymore. I want to do my own thing. And I'm going to buy a franchise. And we're seeing individual operators and multi-unit operators come out of the woodwork to buy franchises, and that's great for the industry. Second, we always try to cross-sell our brand. So if you're a Fat Burger franchisee or a Hurricane Grill and Wings franchisee and you want to operate a Johnny Rockets, great, or vice versa. And so we're talking amongst our franchisees, the 300 of them now, to let them know they have the other brands available either virtually or ghost kitchen, or they can own and operate a brick and mortar restaurant. And look, think about the number of second generation restaurant locations available. I mean, it's terrible. It's also an opportunity, right, for franchisees that want to develop to build more locations. So I think that we're going to see that really play out in 2021, where our operators will open multiple brands and they'll virtual and ghost kitchen those brands.
That should be great for the growth prospects here. And
right, well, we want to grow organically by as close to 10% a year as we can in terms of number of units and sales. And organic growth is free, right? And you want to grow as much as you can, and it's healthy for the system. It grows purchasing power, and it makes your franchisees more profitable. So there's absolutely nothing but the best to focus on is organic growth. Growth through acquisition in this opportunistic environment, it obviously is what Fat Brands is all about. But once we buy these brands, we want to grow them, every one of them that we can.
Great. And you touched briefly on the adjusted EBITDA margin, how it grew 2018 to 2019, and you think it would be with the Johnny Rockets over 50%. Do you think this number can get higher? What's your kind of goal for adjusted EBITDA margin?
Yeah, I mean, a goal would be up close to 65%. And that, is really achievable. But just thinking about the size of our platform today, public company costs are extraordinary, right? They're probably close to $3 million just to be a public company with audit, tax, and insurance, and all the exchange fees and stuff. It's a big number. I think we all know that D&O insurance, for example, has just skyrocketed in the last 3 years. It's quadrupled in price for half the coverage, that kind of thing. So we already are bearing those costs, and the more that we can generate revenue, it just dilutes the margin erosion that those costs have as a public company. So I think that we'll be above 50% on a normalized basis for sure. post-COVID here. And then as we make a couple more acquisitions, then we should really crawl up towards 60%. As we move forward on the financing front to refinance our existing securitization facility and have a longer amortization and have some more bells and whistles to it, which we expect to close in Q2, that facility will allow more acquisitions. And I think the timing would be right to time one or two more acquisitions at the closing of that facility, of that refinancing, so we can drop them in there and spread the costs even further. So I think, again, interest rates come down for us as a company. The deal cost to do another securitization gets spread across a much bigger base, and making those acquisitions just increases our margin. So very focused now on just running the business and opportunistically acquiring one or two more brands that we can grow in 2021.
Since you brought up acquisitions, let's talk a little bit about that. What's the pipeline looking at these days? What kind of size? Are we talking more Johnny Rockets? Are we talking smaller? Are you focused on? In what areas? It seems that you might have the burger area covered. So what concepts would you be looking at?
Definitely feel like the Burger King here with the three different burger brands. We have plenty of burgers. So I think that fast casual, QSR, casual dining, there's a lot of opportunity in casual dining. It's been so resilient for us. We're so impressed with how it's performed through the pandemic that we're very interested in casual dining. We probably don't go too much into fine dining or at all. We probably don't get into too many very, very ethnic brands that are complicated to cook, like sushi or something like that. But there's a lot of stuff out there that's for sale that I don't think we touch because I'm not sure it's savable. And we've looked at things, just as an example, like Corner Bakery. Couldn't figure out how to take the risk on when the urban catering business comes back for office lunches, stuff like that, and high real estate costs. But there are plenty of casual dining brands and fast casual brands that we can grow in our portfolio. And I think there's a few QSRs as well. I mean, look, there's some that are distressed, and we really have to evaluate, are they savable? But there are plenty where it's just the right time for either a private equity owner to sell or founders to sell, and they want liquidity, and they've been through a tough time here owning their own restaurants. So I think there's a huge opportunity. And in terms of size, I like to say that hunting elephants is great for scaling up the business. So Johnny Rockets, adding something that big, we'll make another one of those acquisitions every year going forward for sure to grow. But shooting some rabbits and squirrels along the way, they're easy to add on to EBITDA. They're easy to integrate, and so I think we'll do a little bit of both.
Maybe let's just touch briefly on the steakhouses. They seem to have been obviously the most impacted by COVID. What size of the business are they today, and how do you see those units coming back? In a post-COVID world, is that they seem to be the ones that might have the most difficulty in rebounding.
So Ponderosa Bonanza steakhouse operators have been hit severely by COVID, by government shutdowns, by the lack of additional PPP money or other government programs. And there's been closures, and there will be more closures, and that's the nature of the all-you-can-eat buffet business. Now, we were able to pivot the service style and put an attendant at the buffet to serve the guests as they walk down the line, so guests are resilient and they're back in the restaurants eating again. But when the government forces a closure and there's no outdoor dining and very little delivery and to go on an all-you-can-eat buffet arrangement, it's difficult. So I think that we're going to see significant closures. Ponderosa and Bonanza, great brands. They'll be around forever. It's only 8% of our revenue, so it's not going to move the needle in the wrong direction by much here for us. But those brands are hit the hardest. We don't have that experience anywhere else in our portfolio. So we're very fortunate that it's limited to that one subset of brands, and we'll do everything we can to help those operators get back on their feet. But the government needs to pass the stimulus package and pass more PPP money for those operators.
Okay, thanks for the insight on that. And maybe we can just touch, I know this is something that is often asked, cash burn. Where are you guys on that right now today? And how comfortable are you with that?
Yeah, we have good liquidity. We ended Q3 with, I think, $12 million of cash, so plenty of liquidity. We're not burning through lots of cash right now. We're not making lots of cash right now. We're operating around 75%, which is pretty darn good, considering across all brands when you take the average. And I think that only gets better because of franchise sales and other things that we have going on to meet the new programs for virtual restaurants. So we're okay. We have plenty of liquidity to get through the pandemic. We've been strategic about that in terms of how we raise capital in the securitizations, and when we refinanced ourselves again in September to make the Johnny Rockets acquisition. Very, very fortunate. And look, there's tremendous buying opportunities, so we're saving some cash for that. But we can also drop them into our securitization facility and expand that. So I think it's very effective, but not really burning cash. We're in a really good position, and we're really fortunate that we're not in the fine dining business where those poor guys are just getting crushed.
Great. Well, Andy, that's all the time we have for today. We want to thank you for helping us get a better understanding of the FAT Brands story. If you would like to get the independent research I've written on FAT Brands, go to channelchek.com and type in the company name or the ticker FAT in the search box in the top left company data section of the site. Thanks to CEO Andy Wiederhorn from FAT Brands. Everyone have a great day. Thank you.
This has been the Virtual Roadshow series brought to you by Channelchek and Noble Capital Markets. Log into Channelchek or subscribe to our YouTube channel to get the full catalog of roadshows and C-suite interview channelcasts. Register for Channelchek's no-cost premium content and receive notifications of new releases from both series. Thank you for joining us.